Welcome to Swimming with Alligators,
the VC podcast from the LP perspective,
with your hosts, Alexa Benz
and Ernest Sweat. You ready? Let's dive in.
Alexa, it's great that it's our 100th episode. Can you believe it?
This is 100 Swimming with Allocators episodes. That's 10 DDQs and 90 allocators. Truly, I think the early on, the question was, doesn't every allocator do the same thing? And every episode, I would say, is truly unique.
It really is. And everyone has their different flavors, because there's been episodes where I was like, that is got to be a killer episode. And other people are like, he says that all the time. I was like, okay. And then there's been others where I've said, okay, that was good, but not my cup of tea. And it's been very popular. So yeah, we want to thank everybody who's been listening. It's been amazing. The learnings, the community that we've been able to build of emerging managers, allocators, and everything in between. And then our events that we've had as well. It's been cool. For folks who know when they're stuck just with us, it's a DDQ episode. And so playing on kind of the task that a lot of emerging managers and fund managers have to do, answer a ton of questions. And so we poke fun of that a little bit, where we discuss different topics, debate different concepts, and then answer questions that our guests, as well as audience, and sometimes just us, that we want to ask each other. So for those who want to reach us, email us at contact@swimmingwithallocators.com. Submit your questions. We'll give you a shout out, and we'll appreciate it. So cool. With that, we can jump into DDQ. Starting with
the first D, discussion. These are things that we've been hearing from LPs, fellow VCs, and want to share with the audience because they weren't necessarily on the record. The first thing I would love to discuss, it's an interesting thing I've been hearing from multiple angles, that looking quickly at somebody's deck, a fellow high net worth kind of emerging manager investor was saying, oh, everyone has deal as the main markup for their fund one or angel track record, et cetera. So it was super interesting to start to think about what is the thing that's differentiating for you, and if your story is so similar to somebody else's, because this is a game of hits. And so you're all going to share a lot of the same hits. And this came through in something another LP was telling me, that the spin-outs have the same issue. That initially they were taking tons of meetings from spin-outs, and then they started to realize it was all the same logos, because everybody's claiming on their track record the same big hits. So the takeaway here is you got to be specific about the fact that you sourced it and you led the deal. And it's got to link back to whatever the strategy is that you're then pursuing. Yes, you're going to have your slide with all of your hits, big letters, sourced, big letters, led, because that's something not everybody can claim. And otherwise, those same logos are showing up in everybody's decks.
That's a good point. It actually makes me think of when last mile kind of technology, or kind of everything was becoming B2B, Uber B2B, or X for Uber, whatever. I would always see these decks with the same logos of customers, and it quickly made me start to kind of dilute certain logos if they were always on there, and then others that rarely showed up that were from large corporates or partnerships. I was like, oh, this is actually something I can dig into. And so with this question of differentiation, thinking about the logos that you have on there, and I think it goes I think your piece about source or lead is important, but making sure you actually have the relationships for the back channel, so people be like, who? They're not like, who was that? Yeah. But we never spoke to them. I think it's really important to be very transparent about those wins and saying kind of like exactly what you did for the company, even if you didn't source it. Making sure you describe how you helped the company. And it actually makes me think I'd be curious what you think on this too, Alexa. When we first came into the business, sourcing was like, you sourced it. This person sourced it. This person, and then it was like, but what was never really brought up was like, did you lead in the negotiations to actually win? And then how much allocation did you win? And how much did you help? Those other aspects that I think are more important now that sourcing is like, how hard is it to source a great consensus company today? So you have to be able to bring your differentiation is going to come from the other things that you do. When it comes to Dex, is there just quick follow up? Is there anything else you think that people think is providing differentiation but isn't?
What consistently we've heard is like the strategy. Most people are going to accidentally spend too much time on your strategy, where you're planning on putting the capital and why, and not enough time on your own differentiation as the team.
Yeah. I haven't heard many LPs say this, but I would say successful GPs have definitely told me that when building a firm, the people and like how you all mesh and like each other and respect each other and can push each other matters way more than like the strategy. Because out of that, if you're really like aligned and like that strategy should come and be very congruent and support who you all are as an investing core. So yeah, I think that's wow. That really, that's very obvious. And I thought about it. I knew the kind of like similar logos problem when it comes to talking to founders, but it's just proof that as we've done this over 100 episodes, the jobs and the diligence that's being done on founders can really be applied to fund managers and firms as well. So that's great. My discussion topic is kind of like a light kinetic string to what you were speaking. When talking about kind of wins or common wins, since our last DDQ, the news of Anthropic trying to stop all SPVs was very interesting to me, and it made me think: is this and Anthropic? When were they founded? Like 20? It was fairly recent, right? As a company. I don't know. Well,
I'm gonna have to look it up.
Let's see how good my memory is. I would want to say like 19 or 21, something like that.
Ding, ding, ding.
It was
21.
Ha! That's great. It's on camera too, so it's awesome. And so this fully doesn't apply to them, but it made me think of like, are we starting to see the stay private as long as possible like start to crack, right? And Anthropic doesn't fully fit in this because it's only almost 5 years old. But if another company in past eras had this much revenue, they would have probably been public 2 years ago, 3 years ago. And so it just made me think of like, are we finally reaching a point where the private markets are starting to create their own markets in the way they can, and then we're going to see probably a lot of issues that come up from that. And as one LP told me, is like, we'll probably see the most lawsuits ever, millionaires made and lawsuits ever coming out of the SpaceX IPO, because some people don't know if they actually own it or not. So if we finally hit a point where it's like, okay, if you hit a certain threshold of revenue or a certain maturity of like age as a private company, what's stopping you? Stop trying to time the market. I don't know
Yeah.
how you feel about that.
No, my understanding of it is basically like there was so much capital available in the private markets that you don't need to go public. You can avoid the headache. And OpenAI, Anthropic, et cetera, are only going through it because they've basically like run out of private capital. It's like they've hit their max. Obviously, that's totally antithetical to this like massive demand for secondaries in these companies.
Yeah.
So I feel that is the case for OpenAI, that they really do feel like they're like, well, the last great like pot of money is the public markets. But you know, what does motivate you to finally go public? Apart from that, I don't know. It does seem like a giant headache.
Like I said, I feel like it feels like it's a giant headache now, even as like a super late stage private company too. Um, and we'll see how the plane lands on a lot of these companies when it comes to like post IPO. But it'd be interesting to see kind of, you know, are there lessons learned from that, from other companies that essentially were planning to go public before these companies and now feel like they have to wait. So something to kind of look out on. And I know as an industry, we've spoken about how these companies are getting longer and longer in the tooth, and like, you know, what is the role of a venture capital? Like, yeah, what is the role of venture capital for instituting like, or being kind of the head of the innovation economy in a certain nation in the world? And is it for companies to stay private forever, or are there real benefits to companies becoming public or not?
Yeah. In the case of those three names, whatever, SpaceX, Anthropic, OpenAI, it seems like it's mostly just because if your competition's doing it, you've got to participate too, or else you're one round behind. It's just like required to continue to go head to head. Otherwise, you're at a huge disadvantage if you're.
No. My pondering is, I agree with you, but I'm like, is there any point where people stop using that logic for everything? And I'm fine if they do it, then we have to do it. But I'm fine if both parties end up at the same place for different reasons. But it seems like so much is associated with like, well, if they do it, then we have to do it.
Yeah. I did have an interesting conversation with a friend whose portfolio company was acquired by OpenAI, and the subtext was, "Thank goodness we got cash and not stock."
Well, you heard it here. That's a man. We're gonna but also I think you just messed up our opportunity to get acquired by OpenAI. Thanks, Alexa.
There are a lot of podcasts getting acquired by. Should anybody be interested, do you want to go to contact at swimmingwithalligators.com?
Yeah, we will. We're capitalists, so for the right negotiations, we will be.
We'll just burn your competition. We'll just make it an entire show about how bad your tech is.
Yeah, how bad the competition is, and we'll be state TV for you. Again, contact at swimwithallocators.com.
I've got another discussion topic I would love to bring up here, hear your point of view. Something I am starting to hear from many VC friends and a few LPs is, oh yeah, we've been doing consumer, and it's with an interesting air of defense in their voice. Like, what do you mean we're thinking of doing more in consumer? We've always done consumer. So I'm curious, have you also been hearing more, let's say, classically enterprise VCs starting to broaden their aperture to also look at, I think in a smart way, consumer right now?
I have heard less VCs talk about going into consumer, um, and more founders lately speaking about building in consumer and seeing that's where the real opportunity is. And I don't want to forget your point because I'm going to come back to it. But for founders, what I've heard recently is there's a real question of like, how do you actually build a moat in today's time? And that's going to be one of my conversations we have in the debate section. But I think a lot of people are thinking about, as far as founders, of like, all right, if any SaaS tool can be built, any kind of like UX can be built, you can't depend on a technological moat to push off competition. It's really going to come down to all the squishy things, and not so squishy, but distribution and brand. And that has brought people a lot back to consumer, and even some on hardware consumer, like that being a little bit of a technological barrier for a little bit. And so that's interesting. To your VC point, I'm not going to step on another question I have, but I just feel that there are a lot of wayward, lost venture firms with a lot of capital. And so they're just searching and don't have a real clue of what they want to invest in. And so they want to keep the top of the funnel broad and pull back kind of like what they've been doing in the past, maybe like generations ago. So I think that's a little bit of that. I think also the piece that's happening with, engineers, founders, whoever, being able to build so quickly is that even if you are building a B2B solution, or you're analyzing and diligencing B2B opportunities, you need to be more of an anthropologic kind of investor where you have those that consumer investor mindset and how you're identifying who has the best opportunity to win. Because like I said before, moats are dissolving really fast. So who actually has distribution, who has trust? Because it seems like to me the only moat that you can get to, and consumer's been doing this play for a while, is how do you get the trust fast enough with your customers to then have them give you their data. Because that's what's going to be powerful and beat LLMs and other folks when you have that proprietary data.
Yeah. No, I think that's a good case for Google, frankly. When I think about like where people have already just sort of come to terms with like all of their personal data, and for whatever reason, I feel like Google is taking this more seriously, my personal data, than some of the other LLMs.
Yeah, and we haven't even seen the the cost of all of us using these LLMs yet. And part of us, like I'll say for myself, is just kind of understand. I'm like, well, that when that leak happens, it was it's a part of it. Cost of emissions. Anyway, I have one last quick one for us, and it kind of gets to the point of VCs being reactive a little bit. But I was speaking to an LP a couple of weeks ago, and they said on their tour of San Francisco and New York firms, everybody led or spoke early about their AI strategy. And some speaking about kind of, how they're using it to improve their workflows, how they're using it to see more companies. Or I've even heard others, not from this LP, but from others, teaching their LPs how to use AI. And the question that this LP had was like, is what you're using AI in the tool for actually helping what you're good at and have an expertise at, and what you're is it congruent? I always go back to kind of like that point that Jay made a couple 10 or so episodes ago. Maybe it's more than that. But is the use of the tool congruent with how you work and kind of building on your lead? Or are you just doing it because everybody else is doing it and it's truly just a table stake? And so I was curious if you've heard similar, or just even personally, what's your philosophy on like what is the right AI strategy, AI stack for an individual?
It's interesting. I did take one emerging manager pitch this week where he, I think rightly, was like, I mean, table stakes, yes, I'm using AI to help like iron out workflows. Anything that was like rote work, it seems like everybody's doing that. It's a solo GP. And that's great to hear, because it's like, great, I'm glad you've got more free time. And then did bother to point out some of the things that he's building to improve his own areas of differentiation.
As this LP told me, it's like, hey, I am a fund to fund that focuses on venture and private equity. If I've picked you for a certain expertise, I want you to like, ideally follow on that. And if your use of this tool is to broaden, like now you're seeing 1,000 companies a week, is that really the best use of the tool? And is that building like on your friends or the emerging manager that you saw the pitch? Is it actually building on your differentiation? And that's the approach I've taken for even like my personal use of AI. It's like, really, forget my weaknesses, right? Like I'm self-aware, I know what those are, but early days of these tools, how can I do a better job of thinking in systems, viewing and plotting things in workflows, and then prioritizing those workflows that actually build upon whatever my superpower already is, and incorporating AI in that manner. And that's just a level of intention that, like, again, back to our differentiation prompt earlier, if you don't take the extra layer to think, what is differentiated might not seem like it's differentiated at all. But I think those are the small kind of like, intentioned and activities that you can do to really build a lead in what you're really good at. All right, now to the next D, debate. And this is when Alexa and I bring up topics, fun little games to really stir up different concepts and opposing views that are happening within the world of venture capital. So I'll start us off with one. And the first one I wanted to start off was actually stealing your favorite game, which is start, bench, cut. But I'm going to add a little bit more. So there's start, bench, cut, trade, or suspend.
Ooh. Trade.
You don't even know which one. All right. So the prompt is, and this is because, it feels like it's just been a steady leak of 30 and 40 something venture capitalists not working at their firms anymore. And my question to you is, for a group, when I was starting this industry, I was like, they don't have many transferable skills. I don't believe that anymore. There's a ton of transferable skills if you're a venture capitalist. But my question is, like, what is the best spot for 30 somethings, 40 somethings venture capitalists today? And so the options I'm going to give you are large firm, GP at large firm, GP at small firm, managing partner at starting your own firm. 4 is a VC partnerships person. So anything around BD or something like that. And then last is founder. So.
I think the only real flex is to go founder.
So is that going to be of your, and I'll get start, bench, cut, trade, suspend. And you can make the definitions for any of those.
I think like the most awesome move you can make is I'd say is go founder. I think that shows like the absolute most confidence because you are down to do a whole new role. You're putting all your eggs in a single basket. It's like one idea. And so that's like the biggest bet.
Yeah.
If a friend comes around and they're like, now I'm a founder and this is the thing I want to put my time and money into, that is the highest conviction option. I think that shows like the most belief in themselves and the thing they're building. I would be very curious to hear from you though, what you think all these transferable skills are.
Wait, before we get in that, no, I need to know quickly the others. I want to know who you're suspending, what do you trade, what would you cut, and what would you bench on those other roles?
I want to know all these people, so I give them all, I put them all in. You're telling me the only thing that's left of my skill set is my network, and so yes to everything. I want the GP at the big firm. Yes, multi-stage. Take my winners. Let's pump some cash in there. I want the early stage friend who is going to send me some deal flow. Yes, please. Yes, please. I like the diversity. I even really appreciate the friend who is now running partnerships at some cloud provider because I need all those GPUs. So please, stay in touch.
I get that. Email us
for their own sake. I do think some of these lives are going to be better than others.
Yeah. That's what I wanted the answer for, but it's okay. We can, if you think Alexa copped out of that question, please email us at contact@swimmingwithallocators.com. All right. What was the topic you want to speak about?
Something we hear from so many allocators on the show, and I haven't called them out yet. I just want to do it here. They're all following a barbell approach.
Yeah.
When you hear the same thing from 20 people in a row, what does that make you think?
I don't knock them. I think it's like conventional wisdom, right? I think where we're in, to clarify, barbell approach, you mean like very early, very new, small pre-seed, seed funds and the big names, right? Multi-stage funds, right?
Yeah, precisely. Yeah.
Yeah. At first I would say if you asked me this question probably 3 DDQs ago, I probably would have been, I'm frustrated. I think like, why is nobody seeing that there's an opportunity? But there is a conventional wisdom on why. And I think it's similar to, I'm probably repeating myself, but I think it's similar to the SaaS apocalypse, right? And the feeling of like, why would you invest in a mid-stage growth SaaS company today? And I think if you're applying the same kind of like vanilla SaaS product or company that you were the last 10 years, there's no reason to. Mm-hmm. But if you do have something differentiated, you have been able to manufacture more kind of momentum to consensus. I think there is a place for you and a huge opportunity. And I feel the same way about having more Series A and more growth focused funds. I think that discipline will be appreciated, and it might not happen for a while until returns show up. But I do think that there's an open opportunity in the market because we have a lot of great companies that are growing, that have the resilience, but the graduation rates are just like going down and down. So that's what I hear when I hear it. It's conventional wisdom, but I think conventional wisdom is supposed to be broken by exceptions.
Yeah. I think it's based on good data. Like, you have much higher multiples if you're investing super early, but it's I have been digging into this a little bit, and I think it is basically like SaaS data. So it's a strategy based on outcomes from the past decade.
Yeah. Yeah. That's a good point.
And you might be like, things are moving so fast that I wonder if we need to adjust how we, like, the level of commitment we have to that historical data. One example, consumer has so many more flameouts before you get to like Series A or Series B. And then after that, Forerunner pulled a ton of this data, like consistently way better results. So if you've got a barbell approach and you're only investing in sub $50 million funds or sub $100 million funds, consumer is going to look like the drain on your LP portfolio.
Yeah.
And I think like hardware used to be really expensive, so it wasn't in there. Like there's all this stuff that the barbell approach, I think, is a reflection of the past. And I'm wondering how much we need to adjust it for this new era where companies don't even have to raise money to get started. They're also going to be huge companies that like flame out with a single update from some of these LLMs. So I'm just wondering if history is not going to repeat itself.
Yeah, there's definitely a lag. And that's a great astute point that you just made of, your allocators might be operating on stale or old data that made a lot of sense. And it's your responsibility as a fund manager to help them see kind of like why they're getting in at the right time for your opportunity and why it needs to exist. But if you're not coming with a believable or even kind of definite and confident reason to exist, conventional wisdom says no. Yeah. To that point, my last debate question was, do you, it was really around a number of conversations I've been having with GPs at different firms and hearing their, where they are and their different strategies, whether it's like what I brought up earlier, AI they're using, how their hiring practices are changing, where there's a lot of firms that, said, hey, we hired this way. Everybody does this. Everybody comes from this background, that now feel that that's really stale and really fits only with the old era. So people who it was always like known that, hey, if you don't get hired by this point, you're not coming into this firm. I'm hearing like reputable firms and some non-reputable firms throwing that out of the window and looking for people who are more entrepreneurial, who know things that they don't know, and also who can sell and are good with LPs. And so it's a fascinating moment now where I think my question is, I think LPs need to do for their re-ups and the net new relationships, but maybe it's more re-ups, need to diligence harder on where firms are going and even their operations and where they see themselves going. I think they need to ask tough questions on not just like, oh, who do you think are the stars? It's like, how do you think about addressing other opportunities? How do you, what's your strategy towards competition? And a lot of firms who have like 800 million and up fund size, 800, I would say probably 2 billion, a surprising number of those are doing seed deals and feel like that's the only place they can compete.
Yeah.
So yeah, my take is I think LPs for re-ups need to dig into our strategy. What are firm strategies and how is that congruent or building upon, even if there's adapting, how is it building upon what they're already good at?
I 100% get it that there is a talent crunch. Like the fights, the internal fights you're seeing among all top AI talent, I think is then like reflected back in venture, where those are the mafias that you want to be backing. Those are the incredible deals that are like raising hundreds of millions off of an idea. So if you don't have a person who's in that network, you got to get access to one. And so I think that's where they're filling in a little bit, understandably. So there's like truly a limited number of people who have deep AI expertise. And alternatively, you see that somebody like Bob Iger has just joined a fund, and you're like, I mean, how much is that going to move the needle, right? Like, so when you are thinking about like where you're adding people at the top of your fund, who's giving you legitimacy, I think it's going to be that super like technical, deep mind.
Yeah. Yeah. Something to think about. All right. Next, we'll move on to questions. All right. Just white. All right. We're back. And this is kind of one of the favorite parts of the DDQs is answering questions, both from our audience and our made up audience. And so if you would like to have your question answered on one of our next DDQs, please reach out to us at contact at swimmingwithallocators.com. Thank you. I'll let you go first, Alexa. What's the question that you wanted to ask?
Is it worth building anything for my fund in terms of AI operations and workflows, or is this product going to be delivered for all emerging managers?
Oh, so the old build versus buy.
This was one that was brought up at a luncheon of 20 investors on Tuesday. And it was sort of like, which things do I bother to create and which things do I just wait?
I would say don't create an LLM. That would probably cost a lot of money. But I would say that I am on the side now that as an investor, you should be tinkering with stuff. And so and it's actually even tinkering with things now has actually shifted my view on kind of like what types of tools you should buy. I was always on like the holy grail is a CRM like that works and very customized CRM. Now I think if you have all the unstructured data and the right workflows of agents, it can surface that same information without you even having some interface, right? And so I would say that people should be constantly tinkering with what are the most important workflows that they have, having set dates on like, all right, I'm trying it for a month or 2 months or 6 weeks. And then evaluating, maybe taking an hour every 6 weeks, 2 hours every 6 weeks of saying, all right, what worked? What actually helped me? What was a deterror and actually added more work? And then what have I heard from other people on use cases that they're doing? And more importantly, tools that they're using. Because I think one of the biggest problems, this is across industries, not just our kind of, early user, early adopter bubble. But I've heard from a lot of friends, educated friends who said, no, I don't want to use that because I tried to use one of these LLMs and it didn't work. My question is a question from Ernesto Sweet. Don't know who that guy is. But the first question he sent us was, with all the change, has anything in your approach to diligence changed?
Hmm. Yeah. I think like, I do referrals faster. I do them earlier. And I'm trying to sort of like look back at why. It's not like I have conviction and then I'm checking that they're not a psycho.
Yeah, yeah, yeah. Yeah.
Like, I think I learned, and I don't know that this may just be from experience, but I'm like, oh, you're taking a lot of pitches in Zoom. Just like, don't get down a rabbit hole. Don't do references at the end. Just like start to feel it out early. Just like shoot off like one message and start to do references like as soon as you can to try to kill a deal faster or whatever it may be.
I think for me, it's like really thinking about how durable of a business model does this person perceive, right? If you're still thinking in the old SaaS era, you're like, oh, my tech is great, and I have some momentum in these pilots or even contracts, and that's not enough anymore. So I'm really looking for and asking questions around, does this person really understand how they get more trust and distribution towards their customer base? And then can they build a moat around that? And what's the business model around that? And then also, what's their ability to manufacture momentum? Because manufactured momentum leads to consensus at least a little bit, right? Because every investor should be thinking about, even if I really like this, can they raise the next round after me?
No, it's wild that like pattern recognition as a VC, we don't have the patterns right now. Like a lot of the reasons why you would have been excited about a company or past, it's like these things don't hold anymore. You have to be a little bit more of a futurist, I think.
You got any other questions? Or I got one more. We can end on this one. So from Quad Sweat, it's a lot of Sweat family asking questions. What do you predict will happen in the early stage market after all these IPOs happen?
Okay. What's going to happen downstream?
Yeah, what's going to happen in the early stage after all these millionaires and IPOs and jealous people emerge?
Cool thought exercise. I think we're seeing like real estate prices go sky high in the Bay Area, for instance. What does it do for the early stage market? I think there's already a huge trend that you don't necessarily need to raise capital if you're an adult. Like the kids still can't bootstrap. But this influx of capital, I think it creates a bunch of people that, should they have any ambition left, they will not be coming to early stage VCs for any capital.
Okay.
They're going to own the whole thing themselves if they're bothering to take another swing at starting something themselves. So I think it changes your competition a little bit. It's like none of those people stay working at the companies once they go public. And so what do they go do? I think a lot of them become angel investors.
Yep.
That's going to be annoying as fuck.
That's hilarious. We'll keep it that in.
Yeah. And so like those people will be filling the coffers of the 24-year-olds who are willing to go build something. More competition. Yeah. And they're all going to be preferential to each other. Like you're going to have these mafias of these people who all worked together. Like my understanding is everybody at AWS is all like ex-Stripe. Like they're these like little pockets of people who follow each other. And so I do think that you'll see probably some like mafia-like outcomes then, that like things are being built in these sort of cloistered communities where people trust each other and they're investing in each other. And
Cool.
that's my prediction.
Yeah, I think my prediction is that definitely we'll have a lot more angel investors. I think we also all of the pension funds and bears of venture capital who maybe were a little bit more pro credit or pro private equity, and especially with like the trouble that those asset classes are going through now, who also we can now revisit that maybe they were helped out a lot by these low interest rate eras. I think people will start to be like, oh, well, we need to put more money in venture capital. And so I think it'll be a great thing overall for new managers, new founders, or it might be annoying, like you said, and we'll just have more people starting funds because they worked at these companies.
Our audience is about to skyrocket.
Yes.
Everybody's starting a fund.
And again, OpenAI, we are open to offers since you guys are acquiring. No, I'm joking.
Well, this has been a pleasure. 100 episodes, Ernest. Excited to do 100 more with you.
Cheers to that with my Christmas cup for some reason.
It's always a holiday at Swimming with Alligators.
Always. Stay in touch, and we'll be back next week with another great alligator.
See you later, alligator.
After Portfolio Tile, investing with a smile.